CEO and The Lobster, this time with an actual lobster. Well, lobster hat at least, which is a good improvement. So thank you for everyone whose feedback helped Patrick be forced into wearing a lobster hat. Appreciate your help. Today's episode, we're talking about the crypto news of the last week, which has been very heavily centered around some quite epic banking failures and the impacts of that on the crypto ecosystem.
Yeah, so that's right. So this is, first of all, a point of interest to me as somebody who does like commercials for EC. But we've seen Silicon Valley Bank, we've seen Silvergate, now we've seen Signature implode, we've seen broader news come out today. It's a really, really interesting time. Silicon Valley Bank was, I think it was the 16th largest in the United States, and it was a very spectacular failure. Janine, did you want to take it away? What actually happened here?
Yeah, so there's a lot of things going on here. And Patrick, I think you and I both have finance and economic degrees, right? So we could probably dive pretty deep on the technical and the geek out on what's actually going behind the scenes here. But to sort of put it more in layperson's language, make it a little bit easier to understand, there was a couple of different tiers of impacts. The first thing, quite macro, looking at the economy, Silicon Valley Bank, as the name might indicate, was heavily their banking activity was heavily made up of Silicon Valley tech companies. And as we've seen over the last year or two, tech companies have not been doing so well. The peak would have been around October 2021. At that time, a lot of companies would have been raising funds, VC investment piling in, a lot of money coming into the bank from their depositors. And then over time, those companies have been spending their way through their funds, reducing the amount of deposits they have with Silicon Valley Bank, and the bank's coffers are starting to get a little bit light. Which brings us to problem two, because the way that banks work is they have depositors on one hand, you put money in the bank, and then they take that money and they lend it out to someone else. So you've got people putting money in and then that money being lent out. And a very common problem that companies can get tripped up on, which actually happened to Celsius as well, is when you borrow short and lend long. What that effectively means is that the people who put money into the bank, the depositors, they can take their money out any time, i.e. short term, they can withdraw it, but you're lending your money to people long term and you can't claw that money back easily. So you run into a situation where if everyone's taking their money out, you can run out of funds because you've got all of these really long-term sticky loans going out. And one of the other big reasons for the Silicon Valley Bank failure, which sort of those two things kind of drop down into, is Silicon Valley Bank needed more money. They had all these long-term loans that they couldn't liquidate. So what they were liquidating instead to give them cash was treasury bonds. And investing in US Treasury bonds, if you think this is a really nice, safe investment, it is if you can hold it till maturity. But if you have bonds that you have to liquidate mid-tenure, so maybe it's a 10-year bond and you're having to sell it after 1 or 2 years, you can take a really big loss on those, particularly when the markets have rising interest rates, because Treasury bonds are not so good if everyone else can get a better return somewhere else in the market. So you had a tech sector that was sort of stuttering a bit and less deposits in the bank. The bank needed to make money, needed to, have liquidity. So they end up selling bonds. And it didn't appear that they were really hedging this risk very well at all, which is probably the last and final failure. So they had, I think, of a bank that was worth $200 billion, they had $120 billion in treasury bonds. And Patrick, what's sort of your understanding of their interest rate hedging for those bonds that they were exposed to?
It was non-existent. So as Janine touched on, is financial instruments can go up and down, and for businesses that are wanting to take long-term bets, well, they just want stability, right? They can hedge, right? They can make a bet in the opposite direction to their assets, or what often they do is a bet in both directions. So regardless of which one wins, it's enough to cancel out the losses on the other one. And really, really interesting, for like 9 months of the last, I think it's 14 months, Silicon Valley Bank didn't have a risk officer who's normally the person that manages these things. It's really, really unusual for a bank not to engage in a long-term hedging strategy. Banks normally don't like to gamble. They normally like fixed, consistent returns. So this is a really unique situation that they were kind of putting themselves in.
And what about Silvergate and Signature? So these two banks were typically known as the crypto-friendly banks. A lot of the crypto industry banked with them. They had some neat features, like you could do instant payments between different crypto companies 24/7. But they've been sort of collateral damage, or were they as bad in their accounting and risk management as SVB was?
So they're actually a similar story, but they're different. So Silvergate collapsed before SVB, but it collapsed for the exact same reasons. And that is fundamentally more people wanting to pull out money than they could quickly liquidate and get out to people. And thus, they were put in a really, really difficult situation where they had to make bad financial choices that would leave them short in the long term. They made those decisions. They also made a whole bunch of really, really bad bets on a bunch of really, really bad companies. You might have heard them: Celsius, FTX. So they got essentially caught up in a really, really classic bank run, is that they made really, really bad investments in the crypto space, in the loans they made in the crypto space, and they essentially didn't have appropriate risk controls when something that isn't unforeseeable happened. They were left in a short position and it ultimately affected their customers. Signature Bank, on the other hand, is a really, really interesting situation. So that happened Friday night, Sunday, Monday morning kind of US time this week. And it didn't collapse, right? It was declared a systematic bank by the FDIC. So they're the kind of like, they're a private organization, but they're owned by the US government, and they're the ones who essentially insure deposits. You might have heard this number, $250,000 insurance thrown around. FDIC is the ones that do that. They declared Signature Bank a systematic risk, which gives them heightened powers to actually step in and take over. So first of all, they can do that for any bank, but they need reason to do so. If they sign this systematic risk, essentially the too big to fail, it kind of came around after the global financial crisis, they can step in and just take it over. They stepped in, took it over, and now they're managing the bank's finances under the brand Signature Bridging Bank. And it looks like everyone's just going to get paid out. So there's a lot of questions about why they did this. The management and the executive team of Signature Bank was under the impression that they were actually going to be able to meet the deposit. There was a lot of money moving out, and that was the concern, right? Is if a lot of money was moving out, they couldn't leave them in a short position. But the executive team was under the impression that they were okay. They'd seen Silvergate, they'd seen SVB, and when you see that type of stuff, like even at Easy Crypto, if we see something happen to our competitors, we always check to make sure we're not exposed to the same risks. I'd imagine that they probably did something similar. So we don't know much yet. A lot of this is still behind closed doors, but it'll be really, really interesting to see the justification. And it's led to a lot of rumors, right? That, well, you've had one of the major crypto banks collapse, and then you've seen an organization that's actually pretty anti-crypto come in and take over the major alternative to them. And there's definitely been accusations that this was an anti-crypto move. Whether that is founded or not, we just don't know yet. But it'll be really, really interesting to see the play out. One play out you might have seen, though, is USDC, though. Janine, do you want to touch on that maybe quickly?
So for those of us in New Zealand, this happened Saturday night, New Zealand time, and I was out at a party, and then all of a sudden everything is melting down, and I'm having to, drink down, go and sort this out sort it out for our little corner of the ecosystem. Because USDC, which for anyone who doesn't know, this is a stable coin. A stable coin is something that is pegged to a particular value so that the value doesn't fluctuate. Bitcoin can swing all over the place, but USDC is always pegged 1-for-1 to the US dollar. Makes it nice and easy to trade with, international payments, that kind of thing, really simple with USDC. And USDC is pegged 1-to-1 with the US dollar, and then those US dollar reserves, so every time they create a USDC, there should be a US dollar sitting, in a bank account or in a, nice, safe, liquid asset. So USDC had something like $40 billion of US dollars that it's holding on to as its treasury, and 3 billion of those were in Silvergate. So obviously Silvergate is imploding. USDC, tweet out that they've got this 3 billion exposure. Quick math, 3 billion out of 40 billion, that's about a 4 or 5%, exposure. But we saw USDC in the market start trading down at 88 cents. So the market's saying this thing has already lost 12% of its value because of the exposure it has. And I was like, this feels like an overreaction, 4% loss, worst case scenario. But sorry, is my math right on that? It's 6%, isn't it? 3 billion out of 40. I should have looked at it.
Yeah, it's 7.5 thereabouts. But regardless, just a point on that, right, with how illogical the markets were. This money wasn't gone. It was just locked up for a period of time. It's only an issue, right, if USDC suddenly $40 billion was cashed out, right? Like, that's kind of what made it. This money isn't gone. It's still there. It was interesting.
Exactly. So Silvergate hadn't absconded with the 3 billion. There's a possibility that Silvergate is not going to be paying out 100% to its creditors. So maybe instead of 3 billion, they get 2 billion or 1 billion, but it's not gone. And Circle, like their business model, like USDC is their product, and there's no way that they're going to let, you know, this company made $1 billion in profit last year, and the reputational risk of them not having that peg regained, they would be out of business if they didn't regain the peg. So even if they had to mortgage and leverage and borrow, you would regain that peg and make sure that you made all your customers whole. So it does seem like a very rational thing for the markets to do, to drop the value so high. I'm very sad that while I was at the party, I didn't think about buying up a whole lot of USDC at 88 cents on the dollar. That would have been a really nice way to make 12% overnight. But, you know, USDC is now back pretty much to peg and trading again in a lot of the places that had, you know, delisted it for stability reasons, Easy Crypto included. We weren't able to reliably trade USDC, so we sort of delisted it from the site, but it's now back live with us and with, I think, pretty much the whole of the crypto ecosystem. So yeah, nice little wobble there from the markets and some interesting overreactions, but always a good thing to have those moonshot, you know, maybe trade set. If you're like, hey, I'll buy up this coin if it drops to this crazy amount. You never know when someone's going to accidentally place a $23 million trade for 5 cents either, right? So some good bargains to be had out there if you're in the right place at the right time. We'll probably have to wrap up soon because we've been told to make these a lot shorter than our last one. But one last question before we go. New Zealand and Australian banks. So I'm sitting here in New Zealand, Patrick's in Australia. Do we have these same systemic issues with, you know, fixed interest rate products, devaluing, being booked on banking ledgers at par, having potential runs on banks? Like, where do we sit in our countries? Should we take all of our money out of banks and put it into crypto? Hashtag not financial advice.
Yes, not financial advice. No, so these risks fundamentally exist anywhere in the financial sector, but they're not really risks. So first and foremost, you would have to have a bank that's not mitigating for these risks, which is already exceptionally unlikely before this stuff happens. Second of all, in both of our countries, the banks are a lot more centralized. In Australia, there's the Big Four, for example. They have the ability to invest in other yeah, exactly. They have the ability to invest in other comparably safe investments, e.g. write mortgages. SVB didn't have that option. No one was really loaning money from them. So there's already two things. The third thing is, given the size of these institutions and given how closely they are regulated, and given that this has already happened, our regulatory bodies are probably watching them very closely. The concern is, and I just really, really quickly want to touch on this, is any bank that is close to the edge, though, because this has made the cost of doing business rise because they trust, if you don't trust somebody, you're going to charge them more because it's just, yeah, it's a lot of banks close to the edge are being pushed and squeezed, and people are worried about a systematic risk. However, banks in both our countries really aren't in that position, and ones that were bad places to keep your money anyway, regardless of this stuff happening. So I think, broadly speaking, we are fine, but I can't tell the future. We might find out. There might be another FTX out there. So yeah, always hedge your bets, SVB. No.
That is actually probably the key takeout from this risk, is to hedge, and hedge with, you know, using multiple banks if you can. Obviously, as a crypto company, we don't have that luxury, but, you know, store your funds in multiple places, have multiple supply lines, multiple, you know, investment pools. Don't put everything in one basket. Even if that basket is a bank, it might not be a safe enough option. So yeah, diversify and hedge. Not financial advice, or maybe financial advice.
I think just, yeah, look at the markets, make a reasonable conclusion, come to your own conclusions, and good luck out there, I guess.
Awesome. Till next time.
Yep, sounds good. See you all.